So basically, what is a debit card?
A debit card uses money that already belongs to the person. For example, money from a paycheck is usually deposited into a bank account. When someone pays with a debit card, the money comes directly from their bank account immediately. There is no borrowed money involved. For example, if someone has $500 in their bank account and spends $50 with a debit card, the account balance becomes $450 right away. That's the biggest difference between a debit card and a credit card. A credit card uses borrowed money first. A debit card uses the person's own money. Many people like debit cards because they can help with budgeting and controlling spending more easily. But a debit card also has limits. A person can only spend the amount of money already available in the bank account. So basically, a debit card is a way to spend money directly from a bank account using your own money.
So basically, what is a credit card?
Using a credit card means borrowing money from the bank. When someone uses a debit card, the money comes directly from their bank account. But with a credit card, the bank pays first, and the person pays the bank back later. For example, if someone buys a $100 pair of shoes with a debit card, the $100 disappears from the bank account immediately. But with a credit card, the bank pays the $100 first. Then later, the person receives a bill and pays the bank back. If the full amount is paid back on time, everything is fine. Using a credit card responsibly can also help build a good credit score. A good credit score shows that a person pays money back on time. And a good credit score can help people later when they want to rent an apartment, buy a car, get a loan, or even buy a house. So basically, a credit card is a way to buy something now and pay for it later.
So basically, why can credit cards be dangerous?
Credit cards can feel very easy to use. People buy coffee, clothes, food delivery, subscriptions, and many little things every day. And because the money does not disappear from the bank account immediately, spending can feel less real. For example, someone spends $20 here, $50 there, another $100 online. At first, the amounts may not feel very big, but little by little, the spending grows. Suddenly, the credit card balance becomes $3,000. And if the full amount is not paid back on time, interest begins to grow too. Interest means the bank starts charging extra money because the borrowed money was not paid back yet. That's where credit cards can become very expensive. So basically, a credit card can be useful, but if the money is not paid back on time, interest keeps growing, and people may end up paying much more than they originally spent.
So basically, what is APR?
APR stands for annual percentage rate. APR shows how expensive it is to borrow money for 1 year. It is most commonly used for things like credit cards, loans, and mortgages. For example, if a credit card has a 25% APR, that means the bank can charge extra money when borrowed money is not paid back on time. The higher the APR is, the more expensive borrowing money becomes. For example, someone buys a $1,000 computer with a credit card. If the money is paid back on time, the extra cost may stay small. But if the money is not paid back on time, extra interest can start getting added to the bill very quickly. That extra cost is connected to the APR. That's why people often pay attention to APR numbers before borrowing money. So basically, APR is a number that shows how expensive borrowing money can become over time.
So basically, who decides APR?
APR is not a fixed number created by the government. Banks and credit card companies usually decide their own APR rates. For example, one bank may offer a credit card with a 15% APR. Another bank may offer a similar card with a 30% APR. That means borrowing money from the second bank can become much more expensive. Banks look at many things when deciding APR numbers. For example, risk, profit, the economy, interest rates, and a person's credit score. But the government does help regulate one important thing. Banks must clearly show the APR to customers. That way, people can compare different loans and credit cards more easily. So basically, APR is usually decided by banks, but the rules about showing APR are controlled by law.